Have you ever lived through a crisis? Maybe that was 2008. Who knows? Could have been 1929. But in this video, we are going to talk about the differences between what happened in a financial crisis like 2008 and 2020. Very different circumstances, but we can take information from both of those to understand what's happening today and what we can expect in the coming years. Why do we want that? Well, because when we unveil the truth, that allows us to both thrive and prosper during these uncertain times. So that's what I want to do for you today. Knowing this information will make you better prepared for what's already going on. So the first thing is to look at what happened in 2008. I'm sure you've probably, if not read the books about it, you've maybe seen the movies about that, The Big Short and so on. And that gives us a little bit of information. I've read countless books about that, and of course the Great Depression as well, and everything in between. When we look at that, yes, there are some similarities. But we need to look at why these things happened, knowing that it's not going to be exactly the same every time. But what can we learn from it? So back in 2008, what happened? Well, we had a financial crisis. This started really because of these financial firms and what they tried to do with mortgages, mortgage-backed securities. So they created all this financial wizardry, and that became real crazy, you know it. All right, they used these mortgage-backed securities and started creating derivatives that nobody understood. It doesn't matter because it's real estate, it's diversified, and we never had a problem. Well, of course, that was a big problem. You had job losses as a result of this. There was some serious increase in unemployment that not only affected the financial industry or the real estate industry, it was widespread. We also had asset deflation. So you saw the prices of stocks and you saw real estate as well. You might say, wait a second, how could the stock market fall if this was subprime? How could that be that real estate would fall all over the entire United States if it's just derivatives, mortgage-backed securities, and subprime mortgages? And how could it not only affect the United States, but places like Dubai? Yeah, it went all the way out. That's what occurred. That was the history. You got this business cycle that happens throughout these periods. 2008 is just one where we have, of course, things are getting way too hot after years and years and years of low interest rates, or at least at that time was really low. Well, now we've gotten a little too hot. Let's start increasing interest rates, and let's do it too slow and not acknowledge the fact that we created what Alan Greenspan acknowledged. He called it the irrational exuberance. Oh, yeah. Well, you kind of enabled that, right? I mean, isn't that very clear? These people don't care about you. These people, these bankers, those in the establishment, they really do not care about your best interest. You could vote anybody in you want. It doesn't really matter because the circumstances we're dealing with right now are part of a business cycle. And that is they increase interest rates to punish you in one way. They decrease them to punish you in a different way. And they keep doing this over and over again, creating this cycle intentionally so that they can enrich themselves. It is very clear and documented. In 2020, it's different. 2020 was a very short, going by their statistics, was a very short recession. We had mass fear that was going on, the lockdowns, of course. They stopped the economy. They put it on hold and they said everything's got to be shut down. But then the stock market went down and went right back up in a V shape. Not all stocks, but in general, went down, went back up. The economy did not open up like that, but that certainly happened to the stock market. You had a highly inflationary environment back in 2020, different than what happened in 2008. It took a while, it took years for real estate to come back up and then exceed where it was before, right? But in 2020, oh no, it went down and it went right back up like crazy. It was wild. Why? Because the money was being thrown out there. And so you see the difference. Yes, of course, they did QE1, then they did QE2 and 3. But what we experienced in 2020 was unlike that other situation because they had no purpose. There was no real good excuse to print the money that they did in 2020. There really wasn't. Yeah, you could have argued the stimulus checks for people and so on. But did they need to go out there and buy the mortgage-backed securities, do all that quantitative easing? Absolutely not, because that recession was super short by any metric. And so you look at that and have to say, wait a second, is this really just part of a contrived business cycle? At least that one aspect of it. Okay, and we have these external factors, we got the lockdowns and so on. So there's a lot that was happening in 2020 that was different than 2008, but still it creates a response from the government, as they call it, the fiscal side. And then there's the monetary side, which comes from the central bank, in this case, the Federal Reserve. They pump out the cash. All right. Then we have that not all recessions are equal, so we have to be prepared for any circumstance. But we have the writing on the wall right now today, and we know that as of now, it seems that asset prices are super high, and it's with a tightening that's going on. So that reminds us that the next circumstance, we are already in a tightening cycle, and still asset prices are high. So even if we were to come down significantly, the next change, the next situation would be more inflation. That's what we can expect. I think it's really important to address that. And I'm going to expand on that further here today. I know there's this argument of deflation and inflation, but right now, as of now, have we seen any deflation? Where is it? Is it in this room with us right now? I can't find it. Maybe it is. Maybe I just can't see it. All right. I know I need glasses to read, so maybe that's what it is. What are the current conditions? Inflation right now, today. Consumers are having trouble. Asset prices are at or near record highs in many cases. And the jobs market is still tight. All of these things put together show us that this is a highly inflationary environment that even by increasing interest rates to a level they have not been at for many, many years is still not enough to push this down. We need a basically catastrophic event to take this down. The biggest worry I have is that we only come down a small percentage and then they fire it up again like they did in 2020. Imagine we get a repeated pattern with asset prices where, yeah, they did fall, certainly, but they throw more inflation at it and prices of homes go on average from, let's say, $1 million to $1.5 million to $2 million. What if the stock market went from, let's just say, 4,000 to 6,000 to 7,000? These things are going to be devastating for people because then they're just completely out of it. They have no chance. The middle class has no chance. Deflation would be helpful, but it doesn't seem like the central banks and the policymakers want to create a circumstance where we can experience deflation, a healthy detox. There's so many people out there that will do intermittent fasting, right? Give my body a rest. You would say that. You look at animals, when they're sick, what do? They just lie down. They just rest. They don't eat. They don't do anything. They just lie down. They're resting. But for the central banks, they say, oh, you know what you need? You know what you need? You need more money. It's like Oprah Winfrey is controlling the whole thing. You get a new car. You get a new car. You get a new car. It's unbelievable. You can't do that and have it make any sense in terms of stability. It's just not going to happen. All right, so what can you expect? Well, we can see deflation of ultra risk assets. So anything like a Dogecoin or something, people are going to sell that off. That's the first thing that gets sold off. Not picking on Dogecoin, but you know what I'm trying to say. All right, it's that when there's people are really just gambling on something, they're speculating on something, that's the first thing they'll pull their money out. I'm going to put it somewhere safer. And so they'll do that. And so there are other assets that will benefit as a result of that. Okay, when we have difficulty in the whole crypto space, there's this new coin, this new coin, that new coin, this dog coin, this meme coin. Money will leave that and it will go into the stable coins, or it will go into Bitcoin. That's just one example. But the same thing applies to basically all other asset classes. Money leaves the speculative stocks and it goes into where there is value, where there is stability. Different circumstance, right? Okay. And then you could see that we go into the underserved markets as a result. Okay. So money leaves the craziness, it goes to the underserved markets, companies and businesses and so on. Flight to safe havens, maybe that's going to be considered US dollar, maybe that's going to be considered gold, maybe that would be real estate. It all depends. And we have the immediate reaction from the Fed and the government. That means more money printing, more stimulus. You know the drill. Not good, is my opinion. You could see the assumption that companies will lay off. We don't know. We really don't know how they're going to do so. During these times right now, they're not laying off a lot of people. Yes, there have been layoffs. I acknowledge that. But overall, when you look at the jobs market, it's still pretty tight. And so they don't want to lay off people because they know how difficult it was to attract people in the first place. And so they're just trying to keep people, but ultimately they're going towards AI, automation, robotics. They're trying to get rid of people. That's the long-term goal. Inflationary policies begin to boost up prices and cause further wealth gap. That's the goal. That's the goal for the central bankers. They're going to do that. They are doing that. And each and every cycle, people are dumbfounded. How did this happen? Just pay attention. Just read the history. I've done it. All right. Spot the differences in the cycles. We don't have the same problems from 2008. We have different issues. Absolutely. There's no question about that. And you'll see that from time to time where, there are some similarities, but know that it is different fundamentally. That doesn't mean you can't have a crisis. And that doesn't mean, hey, look, we're not going to have a crisis in real estate because, mortgage-backed securities aren't what they were. We don't have the same pattern. No, that's not the way it works. Okay, that's just an asset class. 100, 1,000, a million different things could affect it. But know that, we got to pay attention to the data that would tell us one way or another if it's in trouble. All right? Anytime we take excessive risk and are rewarded, we will then, this is like people in general, we will then double down in a Pavlovian response and we'll get burned as a result. So what does that mean? If we were to go to the casino and we bet on black, we say, I'm going to throw my whole paycheck on black. Let's go. Let's do it. And we win. Oh, wow. Amazing. How fantastic is this? And then you go in again. Oops, lost it all. All right. I know a friend of mine who went there. He bet it all on, I think it was red, and it came up. And it came up. He basically didn't get it. He said, okay, I'm going to do it again. I'm going to do it again. He did it 6 times in a row and he lost 6 times in a row. So don't just think that you know what you're going to respond with. My friend lost a lot of money in that case there. And he was gambling. He was speculating. Not a good idea. So that's what I'm trying to say. All right. Watch the actions of banks and central banks very close. This is extremely important. What they are doing right now is by far the keys. If you pay attention to this channel, if you subscribe right now or hit that thumbs up button, yeah, you're going to support me. You're going to help with the algorithm and so on, but you're also going to be notified of the actions, every single important action of the central banks and the banks. Okay. Big stuff. Last rate hike could be seen as bullish. So if the central bank, the Federal Reserve says, this is probably going to be our last rate hike, given everything, I think this is it, that starts a bullish trend. So you'll be notified of that on this channel. Okay. And then we have nobody has all the answers, but fundamentals remain true. Okay. Know that to be the case. The fundamentals will always remain true. It takes some time. Sometimes it's like, hey, maybe this time is different. And then you get smacked in the face. And that's never a good thing, okay? Because that might leave a mark. what I want to say to you is that there are differences between 2008 and 2020. And guess what? The next time around, it's going to be different. But we know that there are risks being taken today. We know where the cracks are appearing. We know that the actions in the end of all, whatever the linchpin is, and that's pulled, whatever crisis we encounter, the end result is more inflation. Knowing that, having that information for you, what would you do? What were the actions that you would take? That's a question. That's not rhetorical. I want to know. If you know that these central banks, the Federal Reserve in this case, is going to eventually print more money, devalue your currency, your hard-earned savings getting burned, what will you do? Some people purchase real assets. Other people are taking this and they're starting to shift their money. They're saying, I don't want any part of this anymore. I'm moving my money over here. Others are using that. They're buying solar panels. They're buying, geothermal. They're buying the 3D printers. They're buying big gardens and greenhouses. They are shifting. They're rapidly devaluing dollars, currencies, paper, fiat, and they are transferring that into something that retains value for years and years to come. What actions are you taking today? I'd love to know, and I'll see you on the next one. Take care.